Midwest Growth Partners was formed 5 years ago. We raised $41 million to invest in rural upper Midwest companies. Predominantly, we focus on succession planning liquidity transactions and growth capital investments of established businesses. We have 4 verticals that we focus on, including food and agriculture, manufacturing, distribution, logistics, and business services. We really look at companies that have a long history of success, but maybe lack a plan in terms of succession for the owner to achieve a financial goal. Typically, it's some type of liquidity. And we try to use our equity to partner with their management team, which really does 2 things. It provides the owner a succession plan and the company a pathway to continue forward, but it also provides the owner with some liquidity to achieve some of their other goals in life.
So many times the owner is the chief bottle washer, we like to say. So they probably wear a lot of hats. They might be in charge of HR, they might be in charge of sales, maybe even some on the finance and accounting side. And so what we like to do, obviously we can never replace that founder many times or the owner, but what we like to do is build out a full C-suite. And so the business is not as reliant on a single individual. And that makes the company more sustainable for the long term. So we try to identify places where we need to fill some gaps. So maybe that's a salesperson, maybe that's a CFO or an accountant, maybe it's a COO. And so we try to kind of build out the management team so it's wider and deeper, more robust. And then the business is set up for success, which will long outlive the existing owner.
So when we raised the $41 million, we have approximately 24 investors. We raise from high net worth and family offices, so accredited investors only, of course. But we also have institutional investors, which include banks and nonprofits. Typically, investors that we work with see some other value in our fund beyond just the financial metrics. So while they clearly expect a risk-adjusted rate of return consistent with alternative assets and private equity investing, they also see another benefit, tangible benefit of investing in the rural marketplace, which may have spillover effect for their constituents, whether it's customers or their own membership.
Our second fund, which we anticipate launching here towards the end of the year, is going to have more farm credit investors. We've applied for the RBIC program, which is administered through the USDA.
We do invest with other funds. Typically, they would be other private equity funds that are later stage in terms of the company's life cycle or the capital curve. So we don't ordinarily partner with venture capital or angel networks simply because they're looking at companies that are earlier stage than we would typically invest.
Yeah, certainly on the collaboration side. Typically, angel investors invest in earlier stage investments, which is not a focus of ours. So certainly as we run into opportunities, which we do all the time, that aren't a fit or maybe they're too early stage for us, we can refer those or collaborate on those with the angel investment network. Likewise, if they ran into an opportunity and they could refer it back and forth to us, I think that would be important. The other thing for existing angel investments, as they grow and as they scale, if they get to the point where they do need growth equity, a little bit later stage in their life cycle, then that would be a good opportunity for us, and we can help them continue to grow.
Our funnel on an annual basis typically will include 250 opportunities, and over the course of that 12-month period and through various levels of diligence, we'll make investments in 1 or 2 of those. So it is a highly selective process, but we do believe in starting with a large funnel and then whittling it down from there.
What I'll tell you is that once EBITDA gets north of $5 million or north of $10 million, certainly those larger funds from Chicago and New York will get interested, and they'll fly into Cedar Rapids and rent a car and drive to Fort Dodge. But if it's smaller than that, they won't. And so we try to stay below that $5 million mark because that's really our niche, which we've identified and which we're good at. So really below $5 million is what we're looking for. And then on the lower end, there's a lot of great businesses where an individual or maybe a couple or maybe a few partners can buy a business and then they can go in there and operate it. Those type businesses usually are service businesses and they're not necessarily scalable. And so to have an institutional owner own one of those businesses but not be there day to day, that's very difficult for us to do. And so really what that means is $4 or $5 million in revenue on the small end is kind of where the institutional type ownership makes sense. And so we kind of say $4 or $5 million revenue on the low end, $5 million EBITDA on the top end, and then in that range is a great niche for us.
EBITDA is a universal term that a lot of funds will use as a metric to measure the cash flow produced by an enterprise in a given time frame. So EBITDA is an acronym for earnings before interest, taxes, depreciation, and amortization. Basically, it normalizes the cash flow the company produces so that it can take into account any special effects throughout the year, whether it's tax consideration or management decisions around certain investments. It's a good rule of thumb. It's not something that we place all of our faith in, but it's certainly something that helps us frame up the opportunity as we start to dig in. Obviously, it's higher risk, but it also should be higher return. We think about, from an IRR perspective, before fund management fees, we think high teens are appropriate in this market. Some would argue it should be higher, some would argue it should be lower, but generally speaking, for pure equity investments, so not mezzanine style investing, we think a high teen return is appropriate.
And so there's a lot of great manufacturing companies spread throughout the Midwest, and inevitably some of their owners happen to be baby boomers. And so if you think about a manufacturing company in a small town that has 25 employees or 50 employees or 100 employees, someday that owner is going to retire. And sometimes the employees can have the capital to purchase that owner. Sometimes there's kids that are there that want to take over for their mom or their dad. But when that's not the case, our capital can be used to facilitate a succession plan for that owner. We keep those jobs. Ideally, we grow those jobs, and so we grow the company. And so when we think about reestablishing manufacturing in the Midwest, our role is really to take what we have and then grow it and make it even bigger than it is now.